Good morning. This is Video Morning Brief of the U.S. Stock Market. I'm Rich Paz for Critical Point, Monday, February 3rd, 8:31 a.m. Eastern Time. Brand new trading month, and they've started off with the downside of as much as 120 some points down in the S&P 500 overnight, and then they brought it back to was down about 80 or 90, and it's just sitting there. This was due to the Trump tariffs and then the retaliation of Canada, Mexico, primarily, and then there's many other global things going on. There's many government things going on with the Trump camp and the Republicans and the Maganomics, and it's just bothering people, and they're selling, okay? And so this is the 6-hour chart of the S&P 500 futures, and we can see this huge gap down overnight. That's unusual for the futures to have a gap down for daily performance, but this is also start of the week, so we have a weekly gap down. That's very unusual. That should be like a magnet that the market's probably going back up to fill that gap at some point. But at the same time, it's also a sign of weakness that the market, it almost feels like it's shocked, and it shouldn't be because it knew what was coming for weeks on end here. I think it's really more of a little bit different type of emotion this time around, where people are just angry about everything and just say, to heck with it, sell it, I want out. There may be also some confusion of where we're going, and it may just be that they knew all along this stuff was coming, but they waited for as long as possible with the hopes they can make as much money to the upside as possible before giving up. All right. So we have this gap down, and on Friday I warned you, level 4 top, and I was getting nervous after 1 p.m. It didn't look like it wanted to go down, but at 1 p.m. or a little later, Trump announced yes, following through on Saturday, even though other sources at the White House, Washington, D.C., and around the world or in the country were saying no, they might not work out that way. All right. So they sold it into the close, and then overnight they snapped it down. Now, here's the interesting thing is, by running a calculation of the critical point tool of this up move and saying a violation of that low projects this, notice how overnight it went right into our projection target. That's great. That's wonderful. Even with all that emotion, they did what the math was saying they would do. It's interesting. And it's just setting now, and it's waiting now for 9:30 a.m. Eastern Time to launch the cash market, the real market, or really not necessarily the real market because futures tend to force the cash around, but it's the bigger market, okay? It should be important from that perspective. And we'll see if they follow through, because there is a possibility this can drop. It's been down 120 points. It might drop record amounts, which I don't know what that would be, 150, 200 points in a single day. The model is leaving the door open for that. But we may learn the cash market opens and is actually quite stable, matching what the futures market did overnight. And then it just says, now I want to go back up and fill that gap. And the reason for that is a level 4 bottom is ideally due today and no later. So we've already gone from a top on Friday to a bottom on Monday. And the model's saying for the level 4 swings that occurred during the week, the pops and drops during the week, that it ought to be higher tomorrow. And then it may be lower the next day, or it may delay a day for that. So that's the level 4 swings if you're a day trader, interweek trader. Now, how about the level 3s? The level 3s are really the largest move during a month for a month. And this is a level 3 up move. And then this is level 3 down move, which is unusually short, but it has occurred over 100 years. You could see evidence you have to allow that short of a move. Now, I will say, when I look at the news and data, the modeling is saying really there wasn't a reason to bottom there on January 27th for this level 3. The model is basically just saying this size of an up move is generally all the momentum you need to say, oops, yep, it did bottom on January 27th. So that is the best forecast. It bottomed then. And I said last week, it ought to move higher into this week. But I said, because of this tariff stuff, it's as if the marketplace really wasn't necessarily prepared for it. And they should have been. They knew about it. They just didn't want to do it. And I think they're a little angry right at the moment that this had to happen anyways, okay? And so what it did is it's splitting this level 3 into 2 halves. This is a level 3B, or a half cycle. And now it's going to move up into the second half and final half. to a level 3 top later this week. And it's probably going to be maybe Wednesday, but more like Thursday, Friday, and on into early next week for a level 3 top. So it can recover this week, fill this gap, but the model's saying it's unlikely that it's going back to last week's high. It's unlikely going to a record high. What it's going to do is bounce up to this level 3, and then it's going to pull back down for a level 3 bottom that's not going to show up to sometime next week to the following week. So that's the best scenario. But we have a second scenario. And that second scenario suggests we can move this level 3 on January 27th to today and probably no later than today. That could mean a better bounce into this level 3 top, but it doesn't take away from the idea of just a short bounce into a level 3 top and right back down again. What it would do is delay the future level 3 top, meaning it's probably not bottoming next week. It's going to be the following week and even a bit later. It shoves it farther out. So I don't know for sure which scenario is the best, but we're going with the idea that January 27th was the level 3 bottom. This means today's price action being lower than on January 27th is a warning that the market really wants to go into a level 3 bottom next week. And therefore, the level 3 up move this week ought to be rather limited, brief. It's kind of saying, oops, I went down too fast, too far, bring it back some. Now, oops, I really want to go down after all. If you take both of those scenarios, you can overlap them, and you can see this is probably going to be a sloppy market for 2 weeks, maybe longer, okay? You can see there's still a more negative bearish bias to it than otherwise, but I can also see this news can kind of somehow work its way out when we calm down and maybe there's better support, okay? And that's about all I've got for you. Is this is going to be sloppy for some time. It's kind of like these level 3s are breaking up and they're moving a little faster. The level 4s have more power to the upside, downside, a little more drama. But it's also like the larger level 2, level 1 trends are just kind of falling asleep, okay? All right, the cash market doesn't have a lot to offer here. We'll go to the hourly chart, and there's Friday's down move. Now it's going to gap much lower and be down into here to this old gap there, down into the January 27 low. But if it can't hold there, let's not forget this gap created on January 15th, where it can drop to 5,900 down to 5,840, okay? So that's the near term. The very short term picture is the market ought to be up tomorrow, but the problem is it's going to be a lot of sloppy slippiness, fuzziness as it tries to move up later this week, but right back down next week is the best scenario. It's just I can see somehow it'll work out that way, but a bit different, that it takes longer and even sloppier still, all right? Now, let's go to the daily, and we go to the S&P 500 cash, and there's the negative reversal last Friday. They put it up, they put it down, they closed it lower. It's called a negative reversal, and it was a level 4 top, and it was the second level 4 top from the record high on January 24th, and ideally what it should have done is gone higher into this week than down. And I warned you, we got something different because of the tariffs. The market isn't quite prepared for it. And now they've slam dunked it, and we're going to have to watch the performance near the 40-day average for a potential bottom, a potential rebound before probably going lower still into the next level 3 bottom. If they really want to get crazy to the downside, they can put it down to that 5,900 to 59 or 5850s to fill the gap created on January 15th. They can put it down to the 100-day moving average. I think the 50 and 40s are more watched than the 100, and the 200 is watched more than the 100, but I don't know that for sure. If it can't hold, that might go all the way down to the 200-day average of 56.29, but that would be relative some larger trends. If we can get this market to trade above Friday's high at 6120.91, if it were to do that this week, I'd still sell it anyways for next week for level 3, but I also would be double checking what we're trying to do for those larger trends, okay? until it goes to a record high, meaning it trades above 6128.04, I feel like being bearish all the way to May, June, July, maybe to October. And as an increment inside of that, I feel like being bearish into March. Why is that? Well, we'll go to the weekly chart now and check on it with the S&P 500 cash first. And you can see last week they put it up, and I told you I didn't think it was going to go to a record high. And now we can see it even pulled back quite a bit last week. Now it's going to open much lower, and I'll show you the futures in a moment here. It's pulling back to our fair valuation that I'm actually lowering now. That seems the best analysis here. And the best forecast right at the moment is this market for the S&P 500 put in the more important level 1 top. It wasn't in December like we called, and it's going down into level 2. Now, it is possible that it's not as important as I think, but it still looks like to me, even if they can bounce it the next couple of weeks, they're going to have a problem with it. And eventually it is going down into March for level 2. Up for April, I'm now thinking that up move in April isn't going to be as important as I've been saying for a few months now. And once that top is in place, it's going down for more important level 1 into May, June, July. Lower still. And if you want to simplify this and forget this level 2 down, up, down kind of idea, you would say the level 1 is just down now into May, June, July. And I still believe we're due for minor long-term bottom sometime April or May on into October. So we may be down April, May, June, up and still back down by October for the next level 1 and the final opportunity for a minor long-term bottom. And I still believe relative to this minor long-term bottom, the stock market ought to drop -7 to -11, maybe -13% from the current record high. Or whatever record high we get a little later this year, it should still drop that much still later, okay? Now, that's minimum downside, but ideal downside requirements, okay? We have other scenarios, or I have other scenarios, and the model has scenarios suggesting it might drop as much as 20%. It could drop as much as 36%. That'd be extremely rare. Rarely does it like to drop more than 20% with this kind of pattern and this stage of the major long-term business cycle, okay? But there's also some weird things going on that once a decade sell signal is due out there towards 2030. It might occur now, and if so, we might have as much as -60% this year. Don't believe it, don't want to believe it, but it is on the table, on the very edge of the table, ready to be flipped over into the garbage can, but it is there. Things could get that crazy, that bad. So we've got all kinds of targets, -7 to -60, but really it's probably -7 to -20, and inside of that, probably -7 to -11% or something like that. So we've got to keep looking over our shoulders all year long here for problems, complications, yet the door is still open somehow, some way to still move higher into 2026. Now, on top of all of that, we have GDP eroding, and I'm negative GDP, therefore the economy, until May, June, July, but maybe all the way to the end of the year. And where I'm also concerned of rising inflation. And it might even surge over the next few years to as bad as -13 or positive 13%, which would make interest rates 6% or higher by the Fed Reserve even, which would be disaster for the stock market. Doesn't have to occur. It's just on the table more than any other generation in the past 50, 100 years, believe it or not. But it's on the it is on the table, okay? But it doesn't really have to occur. So the thing to watch out for, is it trading this week below 5963.02? Because if it is, that's also a sign of going lower into March. And maybe we just need to take it one step at a time and don't get overly bearish and nervous for the rest of this year, but also be aware of what else can go wrong and how long can that last. Best scenario is down into March, blip up in April, down May, June, July. Basically, if you want to simplify that, probably sideways to down to April, May, June, July. Even if a record high were to occur now into April, May, June, July, I would still expect a nice drop somehow, some way. All right, so keep that in mind. Any rate, right now, though, we just have to focus on the idea if it goes below 5963.02 in the cash, probably a sign, even though it might bounce very well on a week-to-week basis, every few day basis, it can still go lower, okay, and have problems. And I really don't like where we're going with the economy and some of these other complications and issues. All right, now let's touch base on the S&P 500 futures. We haven't been doing that very well, and here it is, gap lower, but the interesting was it's inside last week's parameters, so that's called a trader's gap, not as serious as a breakaway gap. But nevertheless, this is a serious gap, and it is saying it ought to go higher someday, but it's also bumping its head near the 5-week average. It may have to go lower first before going higher. Weekly indicator trying to roll over for a sell signal now, and it's nearly overbought. And again, I think we have to allow over the next couple of weeks for some rebounds, but overall, it's probably going lower into March is the best forecast. And we want to look out for people starting to speculate more on deteriorating economic data due to the tariffs. Let's go to the interest rates, and the interest rates should be moving higher over the next few months and maybe into summer, and that can be a problem for the stock market. But right at the moment, it's still in a downtrend, and we're still looking for a level 1 bottom. Give me an up week in interest rates. I think we got to jump on it that the market is moving higher in the next month or two, and probably higher into summer. And I think that's going to cause some problems for the stock market. The rest of these indexes, the AI business is kind of negative and making people nervous and cautious. But I wonder, to me, it's more important of what's going on in Washington, D.C., of wrecking the government, this and that. And right at the moment, the tariffs can actually impact the economy, whereas wrecking the government stuff doesn't have to impact the economy in any significant manner right now. But this is just stuff piling on top of stuff and making investors nervous, and they are certainly on the sell side as of overnight in the futures. Now we just have to see, will the cash market respond to that? And I'll finish here with the intraday chart of the futures 6-hour chart. Big gap down. It's going up someday. It ought to be up tomorrow for level 4, but concerned that even though it ought to be up later this week for level 3, that really it ought to be more downside, looking out 1 or 2 weeks for level 3. And then I'm concerned those larger trends are down into March and beyond and so forth. All right, so keep in mind, yes, this market can bounce, and look how well my critical point target range here worked overnight. They just slammed it right down to it and kept it inside that range all night. It might be a bit positive if it trades above 5988.75 for the futures, March S&P E-mini futures. That may be a sign it is moving higher into tomorrow. In the meantime, though, if it comes down towards the low, overnight low of 5935.5, they might need to sell us another 50 points lower than what they did overnight. Past results are not necessarily indicative of future results. We have to keep our wits about us here. This is going to be kind of a sloppy to bearish market for a while, I believe. Thank you.